This week we'll talk about the steps to create a solid finance plan that focuses on risk mitigation and profit optimization. To put together a solid finance plan that attracts investors, we need to focus on the value of the project in the current marketplace. Investors today often like producers to focus on the feasibility of a project, as well as a strong finance plan that ideally includes a senior loan, mezzanine, tax credits and production incentives, in-kind services, and other finance elements that balance the finance plan out to diversify the investor's risks. To understand what makes a project feasible, we have to understand what a commercially viable project looks like. How important are sales estimates? What is the role of pre-sales? How do we deal with the various finance elements, and how should we balance them optimally? How do we deal with the rights, and how do we deal with distribution and potential pitfalls? When dealing with sales and distribution, the first thing we have to look at is hiring a bankable sales agent. A sales agent a bank will lend against. Sales estimates established by that sales agent will reflect a take pricing, which is the low pricing, and an ask pricing, which is the ideal or optimal pricing for license fees. The bank will also look at pre-sales and apply discounting depending on what country these pre-sales are coming from. And depending on the country and their economic value, the bank will allocate, are they economically valuable, hence a Tier 1 territory, or are they a troubled, economically challenged country, in which case they are a Tier 2 territory. We will also talk about the value of the US territory. Pre-sales are sales of licenses, distribution licenses in this case, done before a project is produced. The reason we do this is A, to verify the demand of the project in the marketplace, which translates into its pre-salability. For example, if the project cannot be pre-sold in any countries, that means the demand of the project globally is questionable. Pre-sales should be done in a way that a bank can cash flow them, so we can use them to cover our production cost. The way the bank looks at pre-sales is it will look at what territories have bought the rights of the movie. Tier 1 territories are the economically strong territories like Germany, England, Spain, and so forth. And when they do a pre-sale and provide a minimum guarantee payment, a license fee payment, the bank will discount that payment down to approximately 80%, which means 80 to 100% of the amount mentioned in the pre-sale contract will be cash flowed by the bank and made available to us to cover our production cost. In the case of Tier 2 territories, which are economically challenged territories, that discounting drops down to sometimes 50%. It can also be nothing. In many cases, it's somewhere between 50 to 75% of the contracted license fee amount. When we put a project together and plan a business plan for it, we have to do a few things in order to understand and evaluate the risk. First, of course, we have to secure the rights. Then we have to do a project valuation, which is established by looking at our sales estimates and looking at our pre-sales. Our finance plan should include incentives, which are production incentives provided by local territories where we are shooting our project. These territories often provide a rebate or a credit to us for spending our production expenses in that territory. These incentives are non-recoupable for us, which means we do not have to pay them back. Banking is important in order to use our distribution and pre-sale components and liquidize them so that we can use those funds to cover our production cost. It is important to understand with every finance plan and every distribution agreement we enter into what industry standards are applicable. It is also important to hire a collection agent and to employ a completion bond.